Hello, everyone. This is Zak Gardezy. I'm the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and the host of Money Minutes. So, here on Money Minutes, I talk about some of the latest market headlines and my outlook for what's ahead. So, on this week's episode, I'm going to talk about the latest on the Federal Reserve and what's happening with interest rate cuts. I'll also talk about Goldman Sachs' latest report where they predicted that the S&P 500 would provide a 3% return over the next 10 years. And then I'll also talk about Tesla's latest earnings report where they absolutely crushed it. So let's get right into this week's video. So I'm getting lots of questions about the Federal Reserve and what's going to happen next with interest rates. Of course, in September, we got a 50 basis point rate cut, which was huge. And now clients are wondering, what's next in November, which on November 7th, actually, 2 days after the US presidential election, the Fed will meet again to determine what to do with interest rates. Now, initially, after the Fed cut rates by 50 basis points, and then we heard some dovish commentary from the Fed about future rate cuts, the expectations were that we're going to get some pretty significant rate cuts in November and December as well. I was reading lots of different analyst opinions about another 100 to 125 basis points in rate cuts by the end of the year. Now, what we've seen is that inflation data, specifically the consumer price index for the month of September, came in hotter than expected. We also got some labor market data that was hotter than expected as well. And this has caused investors to reconsider how much rate cutting the Federal Reserve will do by the end of the year. So November, the prediction still is, according to the CME Fed Watch Tool, over 90% probability of a 25 basis point rate cut. However, in December, things have changed a little bit. So prior to some of this inflationary data, the expectations were that we could get a 50 basis point rate cut again in December. However, now the CME Watch Tool is showing the highest probability of a 25 basis point rate cut in December. So clearly the market is starting to reprice its expectations for further rate cuts. And we're seeing that as well in the treasury markets, where the 10-year treasury hit a low of 3.6% in September, and that's crept back up to about 4.2% right now. So the 10-year treasury has crept up. This caused mortgage rates to also recently go up too, and this caused a bit of a slowdown in the housing market. Things were starting to pick up a little bit and then have once again slowed down a bit as mortgage rates started to creep back up. So what this tells me is that the Federal Reserve will continue to cut interest rates, but they'll certainly be very cautious as some of this inflationary data continues to creep in. Now, this does bring up some risk that if we get even more inflationary data, could the Fed pause? And it's certainly possible. However, I think that would be a bit of a drastic move, especially after the Fed just started cutting interest rates. So, however, in 2025, this opens the door for a lot of different situations. For example, if we get some inflation reports where inflation is higher than expected for consecutive months in a row, I think it's no question that the Federal Reserve will pause. And in a worst case scenario, you could even see interest rates go up again. So, of course, the Fed does not want that to happen. So they'll make their next decision on November 7th. They'll be very judicial with what they do. So Goldman Sachs came out with an interesting headline. Now, this analysis was predicated on the fact that the S&P 500, which is a market cap weighted index, the top 10 constituents of that make up about 35% of the index, and that Goldman believes their valuations are overblown and that their earnings growth rate is really going to just fall off a cliff, and earnings growth is not going to keep up with these valuations, and eventually you're going to see their returns become muted. Now, that's one way to look at it. I think it's a rather pessimistic view, and I think it totally misses the mark on artificial intelligence. So 8 of the top 10 names in the S&P 500 are directly involved with artificial intelligence or heavily investing in that technology. So in order for Goldman's thesis to be correct, which I completely disagree with them in this remark, I agree with them in some areas, but this I think is completely wrong. But in order for Goldman to be correct, 8 of the top 10 names in the S&P 500, which have invested heavily in AI, have to be wrong, and that their investments are not going to play out, and that artificial intelligence is, in and of itself, potentially overblown. Now, if you ask any computer scientist, anyone who focuses on machine learning, software engineering, they'll tell you that artificial intelligence is the real deal. And really, what we have access to now is not anywhere near the peak capability of this technology. The other factor to consider is that major corporations are still not adopting it, mainly because there's a lot of regulations, rules, privacy rules that big corporations can't use it yet. But eventually they'll figure out how, and they'll get access to it for their employees. And then you're going to see a boost in efficiency that I think we're not accounting for yet. Additionally, this is just the developed market that we're talking about. Eventually, the emerging markets will see the use of AI increase as well once they get access to it. And that will completely change, I think, revolutionize parts of the world that will see some significant benefit from using artificial intelligence. And then if you take a step back and look at, for example, there's a major space race happening right now between SpaceX and Blue Origin and just billionaires of the world trying to commercialize space travel. I think over the next 10 years, at least SpaceX has an IPO and most likely makes it into the S&P 500. Well, how's that going to affect the index? And then you've also got, for example, satellite internet, Starlink, for example, and its competitors trying to basically compete and fight for the ability to provide internet to parts of the world that don't have access to it. I mean, there's parts of the United States that don't have access to broadband internet. So something like Starlink will completely change certain communities when they have access to high-speed internet. So I think those things aren't being taken into account. They're just looking mainly at, what are the valuations now? And the earnings growth rates are just, you can't keep these up for too long. So once they do start to slow down, the valuations plus slowing earnings, you're going to have muted returns in the S&P 500. I think that's just too simplistic of a way to look at it. When you start to factor in some of these other things that I think we're going to see continue to develop over the next decade, I actually think when you look back 10 years from now, number one, you're going to be completely shocked at the advanced technology that eventually comes out. And then the second point here is that, we might look back 10 years from now and think, wow, some of the entry pricing that we got now was actually quite attractive. We thought it was overvalued, but after some of this technology comes out and starts to be used across the economy, I think we're going to see some incredible growth. Now, the other factor to consider too is, in order for Goldman to be correct, the top 10 names in the S&P 500, the companies that have really led the way over the last decade would have to start to fail. Now, these companies are in their prime with some of the strongest balance sheets they've ever had. And in order for them to fail, it would be a dramatic failure of really epic proportions across some of these incredible companies that are really global at this point. So now I think this headline, unfortunately, was a bit more clickbait than really anything of serious value. And it shocked a lot of investors because, when Goldman comes out and says something, people pay attention. But I just think this headline was just completely wrong. And I'm curious, to see what happens over the next 6, 12, 18, 24 months in terms of market returns and if Goldman retracts this or changes their opinion. So interesting headline, but I wouldn't pay too much attention to it. I think it's completely off base. So Tesla released their Q3 earnings report, and they had an excellent quarter. They beat analyst expectations on earnings per share. Now, they did miss on revenues, but again, there were some really important things that Tesla shared. So I'll talk about some of the comments from Elon Musk. So to kick things off, their gross margins increased to 19.8%. Now, when their margins increase like that, you wonder why. Like, what was the cause behind their increased profit margins? So this is mainly because they had some subscription revenue, some increased revenue from full self-driving. They also had their cost of production hit their lowest level ever, which I'll talk about in a moment as to why that's huge for the company. But then, for example, the Cybertruck became a profitable vehicle for the company. But to kind of circle back to the cost of production hitting its lowest level ever and why that's a big deal, that has always been the biggest roadblock, not only for Tesla, but for electric vehicle makers in general, in terms of producing lower cost vehicles. It's just, it costs so much to make one. And now that Tesla's finally fine-tuning their production costs and getting to the lowest levels that they've ever been to, some of these future projects like Robotaxi, which is expected to launch next year in California and Texas, or for example, the low-cost vehicle that Elon talked about on the earnings call, these things become a lot more realistic when they finally manage to bring down their cost of production. So this has been excellent news for Tesla, and their stock increased over 12% after hours. Now, as a key holding at Wealthstone, very excited about what's happening at the company. This does put a lot of pressure on them for Q4 earnings, so they have to continue this momentum and, of course, into 2025 as well, as they have lots of projects up ahead. But again, exciting news for the company, and we'll be paying very close attention to what Tesla does over the next few months as we close up the year.